Hello, my name is Sherry Bruner, and I'll be conducting Macy's Incorporated's case analysis. The following is a situation analysis for Macy's Incorporated. Key issues are noted and recommendations are included in this analysis. I would like to begin this analysis with a discussion about Macy's current situation. Macy's is headquartered in Cincinnati, Ohio, and was known as the second largest department store chain with a market share of approximately 16.3% in 2020. At that point in time, there were around 551 Macy's department stores, 53 Bloomingdale's, and 171 Bluemercury businesses. Amongst Macy's extensive portfolio, there can be found The Outlet, Macy's Backstage, Story, and many online websites including Macy's.com, Bloomingdale's.com, and Bluemercury.com. Like most department stores, Macy's has not done well due to the current market trends. Since 2014, Macy's has seen a gradual drop in department store related interests. Malls are being utilized less and less by the younger generations. Due to less foot traffic in department stores, Macy's has seen its revenues decrease with time. In order to combat the decline of revenues, CEO Jeff Jeanette has decided to implement the Growth 50 initiative in order to get customers back. Macy's has been under the leadership of CEO Jeff Jeanette for around 34 years. He knows how the company was doing in its prime and now is trying to overcome the hurdles of the current economy. In Growth 50, there are 5 elements the company is working on in order to get improvements on its bottom line. The first 3 steps have been completed as of this time. The first element was to strive for product and merchandising innovations in 50 select stores. This is to make improvements on the current retail standards. The second element is to implement a direct vendor fulfillment model for online sales. This was successful in increasing online sales by nearly double. The third element is the big turnaround plan. This step allows customers to order items online and then pick them up at the store. Having the ease of online shopping but having to go to the store anyways is a great plan on bringing customers to Macy's locations. The fourth element was to expand Macy's backstage stores by around 150 to 200 stores. The reasoning behind expanding Macy's backstage stores is simply because they are not as vulnerable to competition as the traditional department stores are. The last element is to expand upon the already existent loyalty program. Macy's needs more foot traffic, and having a revamped loyalty program may be just what Macy needs in order to encourage repeat business. So far, Growth 50 has produced few positive results, and some analysis suggests that the reason behind this is because Growth 50 is more designed to work for the retail environment of 2010 rather than 2020. Macy's customer demographic is largely made up of older women when compared to the other department stores. The older generation is made up of the baby boomers, which hold a large amount of the purchasing power comparatively to other generations. Another reason for the older demographic is due to the younger generation's preferences for different brands and online shopping. The mall experience is not what it used to be in the early 20s. The younger generation, including the millennials, are starting to prefer shopping from the comfort of their own home. This form of comfortable shopping was only emphasized by the COVID-19 pandemic. Macy's products range from housewares to apparel, including men's and women's. Macy's department stores are supposed to be a one-shop stop. Now, let's talk about Macy's performance based off of its financial ratios. All of these ratios were calculated off of the 2019 financial statements given, unless stated otherwise. Macy's debt ratio and debt to equity ratio are 0.196 and 2.3 respectively. I find this to be of concern because the ideal debt to equity ratio should be within the range of 1 to 1.5. Due to the ratio being as high as 2.32, it shows that the corporation is heavy on the debt side compared to others in its industry. Macy's 2020 working capital ratio is 3.32. This is good news because it means that there are more assets and liabilities as of the time of creating the 2020 financial statements. The earnings per share was $1.82 in 2019 and is on a consistent decline. The price earnings ratio of 2021 is 16.72, which is not ideal but better than it has been in the past. Another important ratio I would like to point out is the return on equity ratio of 0.088. The ROE ratio is of great concern to me. The preferred range is 15 to 20%, while Macy's is sitting at 8.8%. This means that the management may be investing equity into unproductive assets. The last ratio I would like to point out is the quick ratio. In 2019, the quick ratio was 0.19. which means that they may not be able to pay off their debt in the short term. After considering the financial ratios given, Macy's financial state is not preferred. While they have more assets and liabilities, the amount of debt long term does need to be focused on. Another point of concern is Macy's share values. EPS has consistently been on a decline these past years, either due to the economy or other situational conditions. Either way, Macy's is in a financial situation that needs to be turned around before it becomes too late. Due to the findings above, I find it necessary to perform a SWOT analysis. I will first discuss some of Macy's strengths. Macy's has a versatile list of products which are good for any generation and for any need. Being a one-stop shop was always a strength in department stores. Macy's also has Bloomingdale's and Bluemercury alongside their other discount store versions. This allows Macy's to bring in more revenue than most other department stores due to their large portfolio. Macy's is already in the process of restoring their business with CEO Jeanette's Growth 50. Already making the steps necessary to improve themselves should be considered a strength. With their new online shopping programs, customers are able to shop online in the comfort of their own home. Some companies still not have been involved in the process, and this should also be considered a strength. Macy's knows that online shopping is the next step in order to gain revenue. Like any other business, Macy also has its weaknesses. The major weakness of Macy's is the fact that not many people are using malls anymore for their shopping needs. The change in customer shopping preferences has caused Macy's to see a large decline in customers and foot traffic in general. This trend does not seem to be changing, so Macy's will need to make alterations to it in way of reaching customers soon. Another Macy's weakness is related to COVID-19. At the beginning of the pandemic, Macy's had to close around 775 of its stores. This caused a loss of $905 million to $1.5 billion. I consider this a weakness because a store like Walmart was not able to close itself, such as Macy's had. If Macy's had been like Walmart and had not closed, they would have not seen the major loss in financial stability as they did. Another weakness is Macy's demographic. The customer demographic is largely made up of the older generation, women to be more precise. Macy's needs to feel more attractive to all generations in order to stay desirable. The younger generation tends to be more interested in department stores such as Walmart and Target because of their great deals and reputations. Macy's does have some great opportunities ahead of them that they can look into, such as Macy's currently has a program in place that allows customers to shop online and then pick up their purchases at locations near them. A good opportunity would be to have the shipping company ship the packages to the customers rather than to the stores. Customers have learned through the pandemic that the comfort of shopping online and receiving the packages at their location is easier than having to go to the store itself. This habit of receiving packages at home should be capitalized on by Macy's. Another opportunity that could be worked out on is opening up more backstage stores or ones that are similar. Backstage stores are not being affected by the less foot traffic trend. People are still willing to leave their comfort area in order to reach deals that they would not have been able to get originally. There are many different threats Macy's has to deal with daily. Examples of different threats are: one of the most concerning threats to Macy's is the COVID-19 pandemic. The pandemic had been difficult on many businesses and many people. It is not surprising that Macy's had to shut down their stores during the beginning of the pandemic, but it will need to be overcome in order to get over the financial loss it had due to shutting itself down. Other threats to Macy's are its rivals. The biggest rival of Macy's is Target or Corporation. Target is a well-known American department store that is known by its reputation. In 2020, Target was considered the largest U.S. department store with a market of 50.1%. Another rival is JCPenney Incorporation, who has 846 store locations in the United States and Puerto Rico. Like Macy's, JCPenney's has also been on the decline due to the mall-related issues and COVID-19. Nonetheless, JCPenney Company should be considered a rival of Macy's. The last rival is Nordstrom Incorporated. Nordstrom is the third largest department store in the United States in 2020. Nordstrom is known for its luxury department stores. Macy's key issue is its long-term debt and how it's taking up a large portion of their revenues. CEO Jeanette plans to have around $1 billion of its debt retired by 2022. which will help overcome its poor debt to equity ratios. Another key issue is Macy's poor return on equity ratio of 8.8%. The investments being done by management need to be reconsidered so that equity is being invested into productive assets rather than unproductive ones. Management needs to have a meeting on what investments are being done and calculate their benefits. If an investment of equity is not providing benefits to Macy's directly, then it will need to be reconsidered. Another key issue is the online shopping trend. Macy's needs to consider how online shopping has become more popular than physically going to the businesses alone. Since CEO Jeanette is already planning on retiring $1 billion of its debt in 2022, I would wait to see how the retirement of debt will help Macy's financially. I recommend management to have a meeting or conference regarding where investments are being made and their current benefits. If they find an investment not to be profitable or not having a benefit to the company, then it should be reconsidered for different opportunities. My last recommendation is to consider having the shipment of products to customers' own addresses rather than to the stores. I understand the reasoning behind having the product shipped to the location is to get the customers to shop, but the ease of having products received at home will help increase revenue over time. Macy's has seen many obstacles the past few years, which have resulted in a great financial loss for the company. The biggest obstacles have been related to COVID-19 and the lack of foot traffic in the malls. Macy's reputation is still promising, and the corporation has room for improvement. Through CEO Jeanette's Growth 50, there will hopefully be promising results from the changes occurring. If the recommendations provided are followed through with, I believe that there will be positive changes to Macy's financial situation. The decline of Macy's does not need to be forever. With proper changes, I believe that Macy will be able to make a return to being the department store giant it once was. Thank you all for your time and being able to listen to what I have to say. Thank you.